Welcome everyone to a new ATFX video. My name is Gonzalo Cañete, and in this occasion I bring to you a whole report on Citigroup, including fundamental analysis, numbers, projections, past results, and also predictions or estimations for the next coming results, 13th of October for Citi Q3. Last quarter, the results of the last quarter on the table, and obviously at the end we're gonna include on this report also a technical analysis chart report, a chart analysis with very clear levels, with very clear trends. In my opinion, it's one of the best charts I have been analyzing, because you can see very clear what's the situation of the market, and it's actually matching the expectations that we're gonna analyze through the fundamentals, right? So please sit comfortable and let's take a look on the numbers today. This is the financial performance report and growth perspectives for Citigroup. The first numbers I want to share with you is the context that we are facing recently with the monetary policies by the Federal Reserve. Why? Because this increase on the interest rates done for the last year has been working as a kind of boost for this company. Not just this company, many other big investment banks have been getting certain benefits from these policies, mainly because it's affecting the incomes they receive on the interest rates on their loans. It's also pulling or increasing the cost if you consider also the remuneration they giving on deposits. But this is the game they are playing now. Most of the old banks in Wall Street, they're trying to adjust the balance sheet to increase the margin between loans and between deposits to generate an extra income on those interests, right? The perspectives on this context is keep high interest rates for long term. Just a reminder, last speech of Federal Reserve, last speech of Jerome Powell mentioned that interest rates probably gonna keep about 5% by the end of 2024. That means like we are facing high interest rates in a year on front. So it means like more than a year it's gonna keep the interest rates about 5%, which is very significant, and that's why I believe these banks are trying to adjust the balance sheet in regards to these comments from the Federal Reserve. Potential income for the Q3 is 19.23 billions. The total interest total interest incomes generated for the whole year is about 45 billions for 2023. This is based on expectations. If we keep moving forward and we take a look, we clearly have seen this happens the previous year before. From 2021 to 2022, we have seen how the total interest income has growth, and I think this is completely in line with the high interest rates. But it's also linked to the fact that the card emissions and commissions are rising. And they got the best context to rise those commissions, because they got, for the last few years, we never have seen this kind of monetary policies rising interest rates at that speed. So it's the perfect context to increase your commissions, your fees, and your interest on the loans. And card emission is completely linked to the loan business. Total income and cost, a positive outlook. We can analyze that the total income for Citigroup estimated for this year, it's going to be between 78 to 79 billion of dollars. Very good numbers. The increase on cost based on the interest rates is 3.09 on deposits. So let's say the cost of the remuneration on deposits is increasing by 3.09, but the increase of the incomes generated on the interest on those loans they got it is 8.63%. That means that the margin between both are increasing and playing a net positive margin growth for Citigroup. So the net result of this interest rates hike is actually a positive result for them. We can also see the evolution of the net revenue for the last few years, really stable. This is the first thing I want to notice here. as you can see, is not changing too much. The results are really flat in terms of the net revenue for Citigroup, and this, guys, is not a good sign in terms of companies. When we see that the results are dropping, obviously would be the worst case, but even if they keep the incomes completely flat, it means the company is not doing so well. It's not taking new initiatives, it's not improving, and mainly basically it's not growing, right? So as you can see, the results of Citigroup has been really flat the last few years, and that's one of the main concerns we got it. Risk management and balance sheet optimization. What this means, I have been explaining this few minutes ago, but this is basically talking about how they try to reduce the risk-weighted assets. They try to optimize the balance. They try to hold on their balances more assets that generate long-term interest. That means, like, if it will be your portfolio, my portfolio, we probably will try to do exactly the same thing. We probably try to hold long-term assets with a long-term returns, particularly now because the interest rates are high. Why? Because maybe in 1, 2, 3 years the reference interest rates are lower, and then therefore we need to take this opportunity to start to fill up our portfolio or our balance sheet with those assets which are going to generate interest rates, good interest rates for the long term. So I think that's one of the main motivations, even probably one of the reasons why the bonds have been experienced this volatility recently, right? Let's analyze the EPS, earnings per share, from the last quarter, the Q2 and the Q3, just to see the main difference, because we will see that actually it's dropping. It's not also dropping from one quarter to another, it's also dropping from one year to another. Let's take a look. We got the previous period, the Q2 on 2023, the last results presented in July. It was $1.37 per share, the dividend, the profit, the EPS given to the shareholders, and the estimation for this Q3, it's $1.22 per share, which means like it's dropping. Also the revenue, actual revenue on Q2 was like 19.44 billions. The estimation now is 19.28 billions, a drop on that net revenue. So it's dropping the EPS, it's dropping the net revenue, and it's also, you take a look here, we're using the data from Seeking Alpha, the website. This data is showing to us that at least this number 8 next to the red triangle shows that at least 8 times has been reviewing or downgrading the expectations, and only 1 time has been upgrading the expectations based on the analysts who are reviewing this company. And I understand why. If you take a look also, the consensus EPS estimations year by year has been dropping. For the EPS for this year, for 2023, is estimated to be $5.71 per share, but that's a drop of almost 20% comparing with the previous year, and not even talk about the 2021 when the EPS was around $10 per share, 10.20. Right now we are in $5.71 per share in 2023. It means like it's actually cutting the EPS from one year to another. In the last 2 years, it's a drop of almost 50%. So very important point to mention on this report is this: the EPS, the reward paid to the shareholders, is dropping 1 year after another. Finally, the chart. Let's set the full screen for take a look into detail. This is the chart. You can see here from 2016 to the current moment, and you can see that since July, more or less July 2022, even I say half of Jan, so the starting of summer of the previous year, it was the last moment when Citigroup was actually trying to do a kind of good performance in terms of price. It was close to $80 per share. Right now it's in 41.75. So there is no doubt that we are facing right now a downtrend on Citi. Does that mean that we need to keep this company away from our portfolio? Well, if you already got into your portfolio, maybe it's too late to just make to yourself that kind of question. It's probably best just to hold to see if they can just recover part of the price they dropped for the last few months. But if you are actually not an investor of Citigroup, maybe we are actually facing right now a good discount on the prices, because we are right now close to $35, $37 per share. I think the range levels I give to you is $37 to $35, yeah, exactly, per share. I think those levels are the levels that are close to the supports, long-term supports. As you can see, if you buy Citigroup around the current levels right now, the current price right now, you're buying Citigroup at the prices of 2016, which is not bad. The prices of 2020 during that massive crash during the COVID-8. So I will say that it's not too bad. The price is really discounted. It's super low price for this company, and therefore maybe it's a good choice to buy between $37 to $35 per share this one, and keep on your portfolio in long term to see what they can do in the coming months, to see if they can improve, because as you can see on the fundamental numbers, there is not so much improvements, and therefore it's pushing away investors from the company. That's why it's a good reason to start to act against the common feeling of the market, the common sentiment of the market, and start to hold those companies who are highly discounted. And I think this is one of the cases, right? That's all from my side. I hope you enjoyed this video, and remember, if you got any questions or you want to share with me any ideas, or you want to propose any other videos, leave the comments. I'm gonna read it and we're gonna prepare that video for you. Okay, take care guys, bye bye.